There's a few things that have happened over the course of the past 2 weeks. So, we're down about 7% from last week, maybe a little bit off from that. So there was definitely saw a little bit of the down. Today, a lot of you saw that the market started down about, was it 3% earlier today, Itai?
Yeah, it opened about down 3% after the weekend.
It opened down 3% and it finished up 1%. And why did that happen? Well, the Fed came to the rescue again this morning. So you guys will hear us reference previous calls. We keep a lot of these recordings. We definitely had a really interesting presentation about the Federal Reserve and how they've kind of influenced markets. Yeah, I know, Paul, you didn't see that one coming. We didn't see it coming either. But anyways, they're basically showing markets that they're coming to the rescue whenever things start going down. And, today is interesting. We're going to talk about, is this the fastest recession ever? But there was also some interesting topics that we wanted to talk about. And one of them is the rise of the Robinhood trader. So I think it's very important for you guys to all understand what a Robinhood trader is and how that's been impacting markets, because it really has been. And so Itai's actually put together a presentation about that, so you can kind of understand a little bit what's happening there. So we're going to cover a little bit about that. We're going to have a quick presentation going into the Bond King, Jeff Gundlach's view of the market as well. So we're going to talk about all this. When you guys have questions, the whole point is to make this interactive. So we want you to be able to, to ask away, and we'll be taking breaks along the way to do that. So without going any further into it, I'm going to pass you off to Itai, and he is going to give us a little update about the world of Robinhood.
So a little story that I've heard, I think I read it in Reminiscences of a Stock Operator, which is, by the way, a really, really good book. The story goes about the dad of a famous president, JFK. He was a pretty renowned stockbroker, and it goes back into the 20s, where he goes to get his shoe shine, and he sits there on the chair, and the shoe shine boy recognizes him and tells him, "Hey, you should probably buy this stock and that stock." And he figures, well, if the shoe shine boy is telling me those stories about what stocks to buy, that means that there are no more buyers left in this market. Everybody is already in. And he famously sells all his stocks. Oh, thanks for that. So he famously sells all his stocks and even benefits from the crash of 1929. Famous anecdote. I'm not necessarily sure that the current situation relates to that, but here's our perspective on it. Over the past weekend, so me and Jeremy own a couple of hundred residential units in Central Texas. And we organized a little summer party for the management team, maintenance people, and all that stuff is something that we do. And as we go there, one of the guys there, who has clearly never traded stocks or anything like that before, started talking to me about all the different call options that he's buying about different things. And when we start talking about it, he's in fact a gym teacher. He's never traded anything in his life. And because he's out on COVID, he doesn't have any work or anything like that. He just started doing that, buying calls and buying this. So I started telling him, so how do you hedge for the time decay, for rates and change of delta? He had no idea what the option Greeks were. He didn't know about time decay and options and a bunch of things that make that investment really intricate. So it just made me think, how prevalent is this in the market? And I just started researching it more and more. And I created the following presentation for you guys. So without further ado, I'll go right into it.
Sounds good. I'm excited.
All right. And as the slide says, welcome to the Robinhood market. Is it taking from the rich and giving to the poor?
And did you choose bubbles on purpose, or is that just how the slide turned out?
It may or may not be a coincidence.
Okay, cool. Just wanted to check.
Here's a funny story. About a week and a half ago, there was this Chinese company, ticker symbol DUO, I believe. But their name is Fanged. unlike the FANG stocks that everybody's heard about, right? Facebook, Amazon, Netflix, Google. So it seems like some people heard about the, FANG being something everybody buys, and a bunch of retail traders that, don't necessarily know what FANG is, decided that they're going to go in on FANGed, that just has a similar name to it. And within a matter of a few hours, the stock surged by 300%. So for those of us who believe in the efficient market hypothesis, that everybody discounts information correctly, as we've discussed in our previous call, it's pretty hard to explain why 15,000 retail accounts on Robinhood decided that they're going to buy this random Chinese network company that you could see over those few months has literally traded flat with not a lot of activity, and all of a sudden the stock just surged. Needless to say, this graph doesn't show that in the next few days it came back exactly to where it started from. Another interesting story along those lines is Nikola. Nikola went IPO maybe a couple months ago. It didn't really IPO. It was some kind of way to get it through an existing shell. Nonetheless, it went IPO in a valuation of about just a couple of billion maybe. And it has no relation whatsoever to Elon Musk, no relation to Tesla at all. It's just another electric company. So they decided to name it Nikola Tesla. Nice play of words. It seems that a lot of people figured out that it's somehow related to Elon Musk or Tesla. And the stock market cap went to $30 billion almost overnight. Just a couple of anecdotes.
So this company, have they produced an actual car yet for sale on the retail market?
They have not.
They have not. So we're talking this company became one of the top 10 most valuable car companies in the world and have never produced a single product. So we're back to the days of the tech bubble. Is that what you're telling me?
I'm not saying anything. Anybody can do their own research about it, but there are some kind of anecdotes regarding that. And I will talk about some references to the tech bubble out there. So we'll go into the next thing that I found.
Real quick, Itai, did we cover really quickly what Robinhood is in the first place for the other people who haven't heard of it?
I apologize. Robinhood is a trading app and vehicle that gives people the ability to trade with no trading commissions at all. And they've become an incredibly popular platform. I don't necessarily have one or own one, but I've been tracking patterns that relate to it. Actually, let me open it up. Does anybody here have a Robinhood account and has seen how that works firsthand?
We have a number of Silicon Valley people. Somebody step in.
I just had a quick question. Wasn't it started by a guy who runs a gambling site, or who's kind of leading all this charge?
Hey, Rob, you want to say that again? You were very faint in the beginning, but we want you to repeat it if you can.
On the Robinhood, isn't that being run by a guy who was running a gambling site that can't gamble right now? So he's doing a lot of Robinhood trades, has a lot of people following him.
I actually don't know.
He's not actually formally associated with Robinhood. He's one of the executives of Barstool Sports, and he's just a big Twitter kind of provocateur, and yeah.
So. He got a lot of press this week or 2 weeks ago when he went on a rant about quarantining and about his business not being able to be run, and he got a lot of traction from that. And now all of a sudden he's sort of on the news feeds every day. And yeah, the big thing now is his day trading, and that he's taken his passion for gambling on sports and day trading. And I think a lot of people who do sports betting have transitioned to doing more day trading now.
And he's been bashing hedge fund managers, which is very popular anyway.
Yeah. Right. That makes total sense.
Well, that'll explain this slide very well then.
So you can see here call purchase activity. This is just buy to open. So no sophistication, no selling covered calls, no puts whatsoever. Small account activity in millions of contracts in the stock market has literally exploded. And I believe they define small accounts as accounts that are $10,000 or less. So this is pretty interesting. So the gym teacher I
Wow.
met most likely falls under this category and is in that chart somewhere.
Got it. This would be, and just a heads up, we're still getting a little bit of background noise. Itai, I'm not the admin right now, so I can't mute everybody. But everybody in the background, if you can mute yourself, or Itai next to participants, there should be something that says manage all, and you can mute everybody in case we're getting a lot of feedback.
Right.
But what I wanted to say is, so we see all this call activity. Is this what's pushing the market higher over the course of the last week or two? More like 2 weeks?
It's very possible that a little bit of that blow off steam we've seen from the 2,800, 2,900 level. So we've covered before how the Fed was supporting the markets heavily in March and in April. And at some point their purchase dropped to only about 5 or 6 billion a day. And that seems to be right around when activity on Robinhood just went berserk. So there's some element to it. There's also some stock buyback that came back. It's always difficult to explain a specific move, but when you do have so much speculative activity happening at once, you know, it definitely is, I would say it's definitely a part of it.
Got it. Cool. All right.
So we'll go next. I think this one is one of the most interesting things that I've ever seen, actually. So Hertz, everybody heard Hertz has gone bankrupt. Now, again, this is one of the 10 largest bankruptcies that have ever occurred. And if you go to hertzvehiclesales.com, you can see a lot of their vehicles are actually selling for 20% below Kelley Blue Book right now because they have to liquidate inventory. So 3 days after Hertz goes bankrupt, the stock goes up 577%. The next session, the stock drops 39%. And then gets bought right back up and closes the day positive. What's, in my mind, just complete insanity. Hertz got approval from the bankruptcy court to sell more shares, $1 billion of more issuance. That the judge and everybody knew could very well be worthless because equity holders, you know, get the scraps at the capital table when all things are said and done. But the stock goes up 37%. On news of $1 billion dilution in equity that could still potentially be heading to zero.
I mean, which is just straight up crazy, because when you go through bankruptcy, it means you literally can't pay your creditors. And you have to sell everything that you have or restructure your debt, making your equity almost worthless. And now all of a sudden you can keep on selling more of the stock and raising more capital. It's completely bananas.
It's completely bananas. And it's like people are literally buying a company to just bankrupt. My guess is a lot of retail traders don't necessarily understand how bankruptcy procedures work. And they know Hertz as a name and they think it's really cheap and they buy it for no other reason but that, or somebody else told them to buy it. So you can see that the number of Robinhood users holding the stock increased to 160,000 different accounts. Which is 100,000 more than a month ago, according to RobinTrack, which actually tracks the activity over there. And also 140,000 of them hold Nikola, which is more than those that hold Netflix. And this is during the fastest S&P rally in history, going back all the way through the Depression. So, you know, 160,000 accounts getting into Hertz probably explains those insane moves that we've seen in basically a bankrupt stock.
We have a question, Itai, that's coming from Mike. Do you want to share it, Mike, or you want me to share for you?
I'm happy to share it. So could retail investors actually move the market that much with Hertz? If you're talking, these are small retail Robinhood accounts. I mean, can they create that much volatility?
Sure. I mean, it depends on the daily traded volume and the amount of accounts that go in it, but 160,000 accounts is a decent amount of money, and not necessarily all of them is small as the call option buying. And also they make leverage bets with options that have a bigger underlying amount. So market makers have to hedge a larger amount of stock in retaliation. And you could also have some short covering. So it's a mix of things, but you know, it's more about the marginal difference that really moves the stock.
And one other thing, you'll see that Ryan just posted a very astute point in the everyone chat about how people are posting moves in their Reddit threads under things like Wall Street bets. It is definitely impacting markets, and you have already stumbled upon something that we're going to hit on. So we're going to leave that as a cliffhanger until we get to it a little bit later. But you're absolutely onto something.
So this is literally the next slide.
Okay, there we go.
So in my mind, the Fed has created a quote unquote no lose market in an era of social media. So traders go into these forum basically bragging about their wins and talking about the next stock. Our Wall Street beaters has shown an astonishing ability to move prices. So back in February, certain companies like Virgin Galactic Holdings and Plug, they went crazy after they were mentioned on that forum, like literally immediately after. So it's almost like you have Instagram influencers now in the stock market have become like Reddit market makers, market movers, right? Whatever you name it.
And Isa, I want to hit on that real quick. So when he says r/, we're talking about a Reddit thread. So Reddit is a very well-known website where people upvote content, and you find a lot of interesting discussions on Reddit. But these forums are becoming very, very popular places where people are definitely taking action, and it's moving markets.
Right. So now you have these Reddit influencers that are people that post a lot of trades, and people think they have a good track record because they follow them in some previous options. And, they post the trade idea in an option, some kind of single name, and you literally see hundreds of thousands of call option bets being placed on a single stock after being mentioned in one of those Reddit threads, which is just insane.
So does that mean if you were sitting in Itai's shoes, would you want to take the reverse side of that bet? If everybody's buying a bunch of calls, sell some puts a little bit further time period out?
Well, selling calls. Selling calls,
my bad. Yeah, sorry.
Selling calls is a risky proposition, especially with unlimited risk. There are ways to take advantage of it. For the sake of time, I'm not going to go too deep into that. But I wouldn't necessarily take the immediate other side, because very famously, John Maynard Keynes said that the market can stay irrational longer than you can stay solvent. And that's something that I always respect.
Hey, Itay, do you know if the regulators are looking at these influencers at all? I mean, if they're front running this information, I know that they're not registered, they don't necessarily have any fiduciary responsibility, but it is manipulation.
100%. I haven't heard of anything from the regulators, because they can just say, I'm just posting my opinion in a forum, I'm just a person.
Well, that's right. But if they're buying these stocks, putting this out as an influencer and selling into the call buying, that's a little different.
Yeah, I mean, I agree with you. I just don't know if they are actually looking into it, or this is so new. Yeah. And government agencies are normally so far behind.
Pretty slow. Yep.
So I'm not sure how this is all going to end up, but I just find it anecdotally to be very, very interesting. Why do I think the Fed has a lot to do with it? Well, the Fed has created this no lose market, right? So when Jay Powell was asked this past Wednesday whether or not he thinks that the Federal Reserve is moving the markets, he said, well, the central bank's focus is the economy, the labor market, and inflation, and they don't necessarily care about asset movement and direction. Furthermore, Fed doesn't believe or shouldn't believe that they can forecast the stock market and therefore recognize a bubble in real time. That's actually a former Fed chair, vice chair. They're pretty easy to recognize after the fact, but they are pretty impossible to recognize during. I'm not saying there's necessarily a bubble, but when people buy FANGed just because it has a similar name to FANG and they're buying worthless stock, that may be something that the Fed may want to look into.
Got it.
So,
Itai, real quick, do we want to take some questions? How we doing, audience? Anything that's on your mind so far? I think you must have answered everything, Itai, so I think we're good. Continue on.
I have a comment, but I can also save it for the end.
No, comment now. Perfect time.
So the comment is, I don't know how many people partook in the mania, the crypto mania, but like to me, this is honestly just, it's like identical. It's like there were Reddit communities that, you know, would basically start memes around random, you know, shit coins, and they would see insane price movement, like absolutely incredible parabolic moves, and then, you know, a bunch of people would make money, and then, you know, the vast majority would be losers. But this was like going on for a good like 2 years really before it kind of crapped out. But I mean, it wasn't like a flash in the pan. It did eventually crap out, but I mean, this exact behavior, like identical, is just that like the tools, I think, for trading those markets, ironically, spread a lot faster among these niche communities than I guess now. I think a lot of those same people, I wouldn't be shocked, have sort of like moved on to Robinhood and to these same forums. Like I'd be not surprised at all if there was a large overlap.
Cool.
Thanks for the comment.
Yeah, thank you.
Yeah, that makes a lot of sense. And even if this was a bubble, right? History of bubbles. By the way, I wrote a thesis for UCLA about financial bubbles. So I compared the pre and post globalization bubbles, and I looked into tulip mania. I looked into the railroad crash and other bubbles. And what's interesting is that they can last much longer than you think. So even if you recognize that you're having a bubble in real time, human behavior amplifies it beyond where you would normally think that it wouldn't make sense. So even if this was to be a bubble that we're recognizing in real time, that doesn't mean it's not going to go on for another 2 years. Exactly to your point, Tori.
Well, and I think also in the movie The Big Short, you know, it really shows that a lot of those guys were ahead of the curve by a couple of years, but it was costing them a lot of money to stay in that trade to try to catch the down move on the subprime mortgage.
Right. And also, we're in an era of unprecedented Fed support, which I'm going to touch into, which could really extend the length and duration of what we're seeing potentially. Because as we've seen, the Fed is providing some sort of a put option when it was, and I don't know if Gary's here to kind of talk a little bit about where the current balance sheet is, but they were doing almost $300 billion a day during the bottom of COVID in March just to stabilize the markets and get them back on. Which I believe that what we're seeing. Yeah, was there a comment?
That Gary?
Sorry, it's a little hard to add.
No worries. Go for it. I don't know who's speaking right now. Okay. Well, I think we're getting some technical difficulties. Itai, why don't you
discussion?
Yeah, I'll keep going. I think Gary's. I think it was Gary, but I can't hear him very well.
Okay, cool. I can message him separately on that.
No, it wasn't me. It's whoever's shows up as Stephanie.
Oh. Okay.
Hey, Stephanie, we gotta mute you. If we gotta mute you again, we gotta kick you out. Sorry. So Itai, maybe you want to mute her?
Yeah, I did. It's not.
Okay, cool. Itai, let's continue the show. All right.
Sounds good. So basically, as we said, I think that the Fed is creating this unintended consequence of excess speculation just because of the level of support they're providing to the market. And I will go into a couple of more anecdotes about the echoes of the dot-com bubble that I mentioned in the past. So back in the dot-com days, there was this belief that no matter what a company does, what their profits are, what their sales are, it's kind of irrelevant, because if you can flip it over to the next investor in this game of hot potato, someone else is going to buy it at a higher price from you, and they're going to sell it to another person at a higher price, et cetera, et cetera. So they don't necessarily care what they buy, because the behavior changed from I'm buying for the long run, I'm an investor, I have a vast interest in the earnings and profitability of a company, to I'm just in it for a short period of time, and I'm going to flip this hot potato to someone else that's dumber than me and is going to buy it at an even higher price. This theory is actually called the greater fool theory, which is something that we've seen in past bubbles, where people just stop being interested whether or not the company's profitable. I couldn't think of a bigger example than Hertz, right? And we're talking about companies like Weebvan here that went up 66% in the first day of trading. And drcop.com, also online consumer healthcare, they both jumped 62%. Literally within 2 years, they've both failed. Today, the globe.com trades for less than a penny, but in 1999, it was at $40. So what made me think about that is that in April, when they announced on a stock split, which again, potential dilution, they surged 34% and more than 14 million shares traded hands. The company was completely unprofitable. Similar to, Hertz jumping 37% on additional stocks being offered. Another thing that some maybe market technician chartists would identify, they look at relative strength indicator to kind of indicate momentum in the market and over a certain average. So the amount of S&P companies that have just shown incredible positive momentum, that's before the little break we had last week in the market, has been the highest since 1991, just because of the linearity and how fierce and powerful that rally really has been from the bottom struck in March. I mean, you're talking about almost a, what is it, 40% just melt up increase. So a little bit of an indication things may have run a little too far, too fast.
And Itai, when you're looking at that graph, could you show us which part you're looking at, just so everybody understands?
Yeah, so here's that portion in 1991. You can see historical periods where things were a little bit overbought and where we are today based on this indication.
Okay.
It's a little bit lower now as of, that was as before the market topped. Okay, so I'm gonna go into the question of, my opinion is, let's start this way. My opinion is that the Fed has encouraged this excessive speculation by what they're doing with their balance sheet and how they're approaching to the market. So the real question is, does the Fed have a third mandate, basically? And that third mandate is, do we pump up asset prices? Do we have a mandate for rising stock prices, right? And we know the first mandate is full employment, right? They want to have good employment in the labor force. The second mandate is an inflation target. They want to have certain level of low inflation just to make sure that our debt system works correctly. But do they have a third mandate? So as I showed in the previous slides, when Jay Powell was asked, are you looking to inflate the market? He says, no, we're just looking at the economy. We're just looking at inflation. We don't necessarily want or care about asset prices. So I don't think that's correct at all. Here is a look at the OECD, the developed world's pension fund assets. So in 2018, they were sitting at about $28 trillion, goes up to $32 trillion. And as of Q1 2020, they dropped back to 29.8 trillion. So this chart's a little bit hard to read, so I'm going to help you see that. This is a breakdown.
Really point it out here, because on my screen, it looks like almost nothing. Okay. So you're going to have to talk it out.
Okay. So do you see my cursor right there? So we can go into, and what yes, I find interesting, what I find interesting here is the United States is right here at the bottom. The pension assets in the US are 18, almost 19 trillion. And that's 87% of American GDP. If you look at all retirement vehicles, including private pensions, it's 147% of GDP. So now imagine a scenario where the market drops by 50 or 60% and stays there for some time. With our aging population and boomers retiring, state pensions relatively underfunded, and I'm going to touch on that soon. The virtuous cycle of more spending and more consumption could really break, because remember, 70% of our economy is based on consumption. And if we have a real asset price decline, it could be a total economic catastrophe.
Could you lean in a little bit more as to, why that fall would be so catastrophic? Because I think to help me understand that would help me grasp this concept a little better.
Yeah, absolutely. So basically, it could trigger other assets being sold in order to fund retirement, like real estate. It could lead to significant less spending. Imagine your 401k has now dropped by 50%. You're going to be much more cautious with your spending. You're going to try to save more in order to meet your retirement needs and fund into your retirement plan. So psychologically, it's going to affect that. And 70% of the economy is based on consumption. So just the entire economic cycle goes in reverse if retirement assets take a big hit. And they're such a large percentage of GDP. So it has a very large consequence hit to the economy.
So basically, you start seeing, if for some reason these asset prices fall, declines in GDP, a lot of selling of other assets, potential deflation, which could be very bad in a banking system built on inflation, and a whole bunch of other problems that could happen if retirement assets fall in value.
You got that 100%.
Okay, cool. Let's keep rolling.
This is another little chart that leans onto that further. This is the level of funding, or the funding ratio, for the different states, which the best one, Wisconsin, amazingly, they're at 70%. Their financiers are in pretty good shape. At the bottom, we have West Virginia, Connecticut, and Illinois. Illinois was only 26% funded. So you could see that future asset growth at a 7, 8, 9% stock market clip is pretty much essential to be able to meet, to make good on all these retirement obligations. So when Jay Powell says that they don't target that third mandate, I just don't believe him.
And what would be the danger of if he actually came out and said, yeah, you know what, Itai, all right, you called me. We do have this third mandate, but it's no biggie. What would actually happen?
So you're seeing that huge injection of capital in March already caused this massive stock increase and caused this excess speculation in Robinhood and all these, all these unintended consequences that we're seeing. I think the risk is that he still comes out and he says the obvious. It pretty much confirms to people that there's no more risk out there. The stock market's going to go up forever, and just buy and do all the crazy stuff and speculation you're doing. That's why he doesn't say that, because he still has some kind of moral obligation and responsibility to encourage that crazy speculation.
Got it. Cool. Questions, everybody?
Okay. So it's going to be a slow recovery for the real economy. This is based on OECD real estimates. And I'm showing this just to get a sense of the divergence we're having between necessarily financial assets and real economic growth and GDP. This is the clip we were growing as of Q3 of 2019 as far as GDP growth. And this is where we are as of Q2 of this year. Assuming that we don't have a second wave of closures and quarantines in the wintertime, and Corona is just a one and done, it will still take about 2 years to get back to where we were, and more or less at the end of 2019, with significantly more government debt, and I can touch into that later on. If we do have a double hit scenario, it could take significantly longer, 4 to 5 years, as the real economy is significantly lagging financial assets. So this accelerates the current trend. I've taken this directly from the Federal Reserve website. So this goes back here into the 1970s. The growth of GDP is here in the, I guess it's like an earth color, and the growth of the federal debt is here in the blue color. So surprisingly, they were more or less growing in sync. Everything was more or less okay. The economy was growing just as fast as the debt. The GDP growth was actually faster than debt until the crisis. That actually changed, where the debt just started growing much faster than the economy. And right now, we're taking a big hit to GDP as the debt is growing exponentially, which leads us to a problem that the Fed has. And that problem is they actually can't print as much as you think.
What do you mean by that?
The way they print money, if you don't want to turn into Zimbabwe, where you just flood the money, the system with real dollars in the streets, is that you need to have government securities to buy. And government securities can't necessarily grow at the rate you need for the money printing to inflate the market consistently. If the Fed needed to inject 5, 6, 10 trillion dollars, the government needs to have justification to issue all those bonds and spend them. And if they don't issue those bonds, where is the Fed print going to go to? Which is why I believe they started with, we're going to buy corporate bonds, we're going to buy the LQD and J&K ETFs, we're going to do all these MBS stuff. And I think the reason they started thinking about that is because they realize that buying government securities has its limitations, because they may get to the point that there's literally not enough of those.
Where in their mandate did it even say that they can start buying into LQD and some of these other non-government securities?
They're technically violating the Federal Reserve Act of 1913, because there's nowhere that says that they're allowed to do that.
And so what type of recourse would the population even have if they didn't want
that? That's beyond my pay grade.
Okay. Gary, for the next call, you're going to have to be ready, okay?
Okay,
All right.
so
Can I ask a question?
any question about any of this, please?
I have a Fed question. So I recently learned that back in March, they lowered the reserve ratio for commercial banks from 10%-ish down to 0%, not-ish.
Yep.
Is that part of the means to print more money? So sort of letting the commercial banks do the work, or is there something else going on there?
Right. So the Federal Reserve has a few ways to quote unquote print money or issue liquidity into the system. The required reserve ratio, or RRR, is one of them, which is how much cash banks actually have to hold in liquid reserves from what they're lending. It was much higher pre-crisis than post-2008. I believe they dropped it to 3%. Then they incrementally raised it a little bit with interest rates rising. And now they dropped it to 0 because they realized that if banks have the issues and they default on their loans, they're just going to print money and buy out the bad loans. So why even keep it at 10%? That's kind of the thinking. So that's just a way of releasing more liquidity into the system. But that again doesn't mean that the banks are going to lend it out, because they're still going to lend it to qualified buyers. But it definitely encourages more financial speculation, no doubt.
ET, I've got a question for you. It seems like I'm a little confused. It feels a little like a contradiction. A couple weeks ago, we were talking about the Fed, and you were talking about how pretty much it was limitless how much they would buy from the Treasury as the money got printed. And
Sure.
Even to the point where foreign governments didn't matter anymore, because as much as was created, they would be the buyer. And it was just this, this game that they played, and it could get as big as possible. But now you're saying there is a limit, which, and that seemed insane. I guess I'm not understanding it, but where is that not, I'm a little conflicted in what you're saying both of these times.
Yeah, so I think what I said then is that I refer to as, they don't need foreign governments. They can buy as much treasury issuance as there is out there. So when I showed on those slides, they were currently, I believe, owning 80% of all the treasury issuance. So they can buy as much treasury issuance as you can issue, right? But treasury issuance is controlled by the government, which on the fiscal side, Congress and et cetera. So if the Treasury Department doesn't necessarily issue $10 trillion of treasuries, they can't print $10 trillion of money, right? Because
it's more politics now coming into check and not approving the issuance.
Yeah, I would say so. But this is why I think that they've looked into buying corporate bonds, private bonds, and all those other things, because I think they're realizing that limit. And I do think that the third mandate is a big part of what's going on.
Right. So that raises debt, but not necessarily money supply.
Right. Well, the money supply is going up as well, because holding those treasury securities technically does increase the M2, but also you have the derivative side where the government spends the money that they get from the Fed, because when they issue treasuries, they spend it, right? And it goes into the economy. So that increases the money supply.
Okay. Got it.
When does the the extended unemployment PPP run out? I talked to a lot of people, and some of them are just kind of right now, just holding tight, just kind of living off their government subsidies right now. And you're showing that, that's maybe that possible, that W formation that might happen in the economy. And that's what I'm just kind of thinking is, when does all that kind of extra goodies run out for everybody?
I'm not entirely sure. I was reading somewhere around September, but I haven't looked into the exacts of the PPP program.
Well,
and
I know the answer to that, Rob.
and also the forbearance. When does that start coming due on people? So
Larry,
Yeah,
you can take it.
I don't know about the forbearance per se. I know that the PPP runs out when it runs out. In other words, people were able to get 2.5 times their payroll, and they were supposed to have to use that within 8 weeks. But now it's been extended, I think, to the end of the year for that as to when they can use that. But when it runs out, and it essentially was 8 weeks, assuming you were at 100% employment, it was 2.5 months or 2 months worth of payroll. So when it runs out, it runs out. There's very little left. There actually are still some funds available, but it's down to under $100 billion. And when that gets used up, and and it's been allocated, so there's, as of right now, no more coming. The unemployment issue, that extra $650 a week, I think that was only supposed to be through the end of July. And I think that's still the way it is, but there's a lot of talk that they're going to extend that, as well as potentially payroll tax holidays and things like that. But that program, the PPP program, in and of itself, is over, and it runs out when the money runs out for people to spend. But you're right; it's going to be falling off a cliff, because as soon as these businesses run out of that payroll money, they will get the forgiveness, but they're finished, and now they can let the employees go when they go back onto unemployment. So it's going to be an issue. I think it will be a cliff, and one of them is coming right now because you're hitting that 8-week mark.
Yeah, and the 600 a week unemployment that's scheduled to end in July, I think the political pressure is that they really are going to end it because it's keeping people from going back to work. So they're looking at other ways of maybe reducing it or removing it, and instead providing bonuses for people that do go back to work.
Yeah, because what that does is, if you have somebody who's making $50,000, they're getting unemployment as if they're making 100, and or rather, if they're making 30, they're getting unemployment as if they're making 50, and that's clearly a disincentive. Why would you go back to your $30,000 job when you're collecting $1,000 a week?
Yeah, I would say so.
Yeah, so as we approach that date, that might be another possible catalyst for some kind of stock market move if that money starts drying up.
And you said it was when in July?
I just heard the end of July. I don't know the exact
Yeah,
date.
July 25th, something the end of July.
Okay, so we'll track that. We'll track that date.
But they may extend it. Who knows? Yeah, they'll probably extend it, but there may be qualifications on the extension. There were no questions. This is pretty much no questions asked right now.
Right.
That's fair.
That makes sense. Any other questions on any of that, or I'll do a quick review of a couple more things. Up to you guys.
Okay. If you want to review some more things, we can do it, and then everybody, will be able to take questions, and we'll make sure we definitely do Q&A.
Right. So I'll just touch on a couple of stuff from Jeff Gunlack's presentation that I saw this week. I've met him once. He's a really, really smart guy. He taught me a lot about derivatives of Australian dollar and copper prices and demand in China, which I would never forget.
So for people who have not heard of Jeff Gunlack, he's the bond king. He's based in LA, and he runs, God, I don't even know how many billions of dollars through his funds, but he is a big deal.
Yeah.
I like his Twitter. I like his Twitter feed too. So if you want to follow Jeff Gunlack, I'll get you his handle and I'll send it.
I think he runs like $250 billion or something like that. Anyways, very, very quickly. So change in GDP 2019, GDP grew 800 billion, debt grew by 1.2 trillion. So far in the first half of 2020, 2 trillion loss in GDP and 3.5 trillion increase in debt, which is a 10% drop in GDP and a 15% increase in debt for people to do the math. So we're getting into the borderline of insane. We've talked about the Fed balance sheet numerous times. I just want to show it real quick. The entirety of QE1 right there, little baby, QE4, which started in March, is already at almost $3 trillion. So I'm not surprised this is the fastest rally in the history of the stock market. I'll go very quickly.
What's twist? By the way, what was twist on the middle of that chart?
Twist is when they decided to roll over expirations from bonds that are maturing and just buy the long run. So this is what I'm most concerned about, and it's what keeps me up at nights, I guess. That's the expression. That's not really keeping me up at nights, just so everyone's clear. Japan's debt to GDP numbers going back, I think, to the 1920s. That's the run up in the war. Then it goes back down. Here's the thing. Japan's debt to GDP increased over the 120% mark in 1998. And it just continued to increase rapidly as they've done, God, I don't know, like 15 QE programs. And they just never ended with the money printing, and they're in negative rates. And they've done anything you can imagine under the toolkit of Keynesian economics and modern monetary theory. And they're sitting, I think this chart goes to 2015. So they're way higher now. I think they're closer to 300 some percent, if not more. And the thing is, it didn't really do anything. At some point, the debt overhang is so big that it just suppresses real economic growth. And they also have this massive demographic issue. In a lot of ways, they look a lot like a 20 to 25 year
future for us.
Yeah, I mean, I would say their demographics look a lot like our current demographics, but yeah, exactly, like a 20, 25 year lead time. And I want to show here a chart of the Nikkei 225, just so we have an idea. They peaked up here in 1989, and they go through their 120% debt to GDP in 1995 when they try to save their asset prices they want to increase after this crash. And we're at the same level. We're at the same level. They've passed 120% GDP. I think it was 1998. So right here. I mean, this stock market has done nothing since 1991, and it's significantly lower than the bubble peak. So I find that pretty concerning as far as what the QE programs look like and what the future could potentially look like. So I'm not saying this is going to happen, but I'm saying that people that grew up in this consistent rising stock market, this Warren Buffett mentality that just buy good companies for a good price and hold them forever, I'm having doubts about that, just given the levels of debt and GDP growth that we're seeing, and potentially the Japanization of the world. So we can't take equity returns for the next 20 years for granted, which is kind of the moral of the story here. Here again is a little bit about the Fed and the Bank of Japan balance sheet. So we're at 32% of GDP right now as far as the Fed balance sheet. The European Central Bank is here. The Bank of Japan is totally in the crazy area of 116% debt to GDP. I mean, the balance sheet debt to GDP. Well, what has that done for them? Well, they've taken their stock market in 2012 from 8,000 to 21,000, still significantly lower than their bubble peak. And that only cost them, went from 40% to 115% of GDP. So, and they're buying ETFs. They're doing crazy things in there. I'm not going to go too much into it.
Itai, if I thought that Japan was a good model for what might happen in some of the Western countries, and I wanted to learn more kind of about their history and what's happened, where would you go to do that?
They're good. There's good resources on the internet. You should just look up the Nikkei bubble. And I think there's a good book, but I forgot the name that I've read. Yeah, the name slips my mind. But what's interesting, they had a crazy real estate and stock bubble in the 80s. There was a time where I think the real estate in Tokyo was worth the same amount as the entire real estate in the US. Anyway, that bubble popped, and we all know the rest of that. Back into today, even compared to other countries, the US has abused the dollar the most. Given the drop in GDP and the budget deficit, the U.S. is far away from every other country as far as how much we're spending on different programs versus the drop that we're seeing in our GDP. Now, Superman, of course, relates to Jay Powell for saving the world. And there is some indication of return to normalcy, but you can see that we're still very, very far away from anything that was pre-crisis. Florida and Texas are leading with 50% below where they were pre-COVID. New York is still almost flatlined. California is starting to come up a little bit, and the U.S. is still 3/4 of a way as far as seated dinners.
And as an anecdote too, literally sitting in downtown Austin, Texas, I can say that those numbers seem to make sense. You know, we see hundreds of people on the lakes just paddleboarding, lots of people out at the restaurant. Doesn't feel like they're packed, but it's starting to come back a little bit more.
When you've gone out to eat in Austin, have they been now having you, not handing you menus, but just having you go like on a phone app and doing things like that? Just regular, just like it was before?
They're braving it out here in Texas, man.
It depends where you go. I've seen both. I've gone the phone menu thing and I've gone the paper menu thing. So it depends what restaurant you go to.
Cool.
So hotel occupancy, and I keep reminding you guys that those are stocks that have surged by 50% or more. So hotel occupancy by week, the 2009 recession is interesting, was only a 10% drop in the mean occupancy from 2000 to 2018, and it caused such a big problem and disruption. We're so far below those levels just in comparison. So I found that to be interesting, but we are seeing a tick back up. Hotel occupancy now is sitting on, the 35% area. Talking about your PPP, that was sources of financing for small business. This actually is over 100% because some businesses use more than one source, right? But back to your point, Larry, when those programs run out, there's a real risk of real defaults, asset price decline, including in real estate and things like that, because they have to let some of reality to tick back in. So the real question is, how well is it all going to get digested? So I know we're kind of like short on time, and there's a few more slides, so I'm just going to open it to Q&A for now.
And Itai, I'll make one comment too about those asset prices on the real estate side. So one of the things that we see, and we talk to the other owners, like I think everybody's saying that in the real estate world, the people who want to buy are expecting a 15 to 20% haircut. And right now, while PPP has been going on and people can still pay their rent, the people selling have a delta of about 10 to 15%. And everybody's kind of waiting for those programs, and so they can start seeing some of the pain, and then we're going to reassess and see what happens in the asset prices over here. So we'll be tracking that, and anything we see on the real estate side, we're going to be sharing back with everybody here.
Cool. Just want to open it to just general Q&A about anything and everything we talked about. We're quiet today.
I feel like we should talk about what's going on behind Rob. I hope he's okay.
So what is happening behind Rob? I can't even see.
Well, I mean, as you're talking about thing, I'm showing Chernobyl, the Chernobyl fire, California fire. I just feel like it's just kind of the mood that's coming out of me while I'm hearing Itai talk.
Well, I don't want to be all doom and gloom. I hate doing that too. It's my job to kind of just show reality, because I feel like a lot of the news outlets and other sources just don't have an incentive to do that per se. And I am optimistic because I think that, problems can be worked, but in order for problems to be worked, they first have to be acknowledged. Well, and I just want to give a different perspective.
I think, like today, one of the things we read was like 24-hour fitness, which we knew was happening. It was going to file bankruptcy. And I think the stat I saw was like 28% of the people that used to go to health clubs are now just going to stay home, just have their home gym. And I mean, our whole economy is just kind of just in this state of flux, as far as everything's happening.
I don't believe it. People have such a short memory. I mean, it just depends on how it turns out and how long it's going to take. But I think people will snap right back to old behaviors. Maybe not so much, maybe not entirely in how they work, but in terms of the things that they want to do, I think they'll snap right back. But Rob, you might want to put some palm trees up first, because like Itai said, timing's a bitch on these things. And you can get, I do a lot of stuff with RSI, and you can have you can be at 75 RSI and go to 80 and stay there for a really, really long time. It's just insane how long some of these irrational things can play. There you go. How long some of these irrational things can play out. But when they turn fast.
Oh, Rob, much better. Look at that. So between Rob and Alex's background, we have some level of positivity. Okay.
Alex started with his colonoscopy picture, so I think he changed it out.
So Itai, I get a question in here, and this might be too general.
That was a barbecue picture.
Was it? Okay, so Itai, one of the questions I've got privately in the chat is the unanswered question is, what do you do with your money and why? Okay, so we've talked about a bunch of stuff, but let's talk about how it affects every single person here. What do you have to say?
So I think like the broad approach that, I believe in my investment philosophy is you just have to be diversified and hedged. So you just have to be in a bunch of different things. You find things that are not correlated to one another. They have some kind of edge in what they're doing. You keep a large part conservative from volatility because you don't want to lose large amounts of money. And you just don't rely on the equity market as the sole driver of your returns because I think, that's just a risky proposition to have. So if you have a mix of a lot of different baskets, those baskets are not correlated to one another. That's generally the way to do it. And there's just various strategies you can go into to provide returns in different kinds of ways.
So if everybody else here has been sitting here and they've been told, well, there's stocks, there's bonds, there's real estate. What are some of the other categories that people could be looking at where that could be a part of their portfolio?
I mean, there are various things. We had a conversation about gold and how gold is a good hedge for inflation. Besides for cash flow, you mentioned the multifamily real estate. There's managed futures. There's various funds with various strategies. Each investment strategy has its kind of like day in the sun. So, even if you were to buy just the S&P 500, I would still recommend either going into a fund that hedges that, like we've hosted Mike Dever here. He talked a little bit about that, or even do it yourself if you're knowledgeable with options. But just the idea of saying I'm just putting all my faith in the equity markets is something that I think is a risky proposition.
Yeah, and maybe at some point too, and a group we'd like to get some feedback here. If we were to maybe someday cover all alternative investments in a little bit more detail, I think that could be kind of interesting because there is a much bigger world here than just the world of equities. I have one. That would be great. Okay, well, all right, we have that would be great, and then art. Chris, I love art with the exclamation point. I dig it. I just have no idea what good art is. So we'll need somebody that can coach us.
I can tell you what good art is.
Interesting at some point for you and Itai kind of talk about your real estate. If you all have a lot of rental units, like when you all got involved, what issues you've had, what you've been seeing the level of success when you bought, were you just waiting for fire sales? Because I know a lot of people that do real estate, and I know some that have done very well, and I know a single family unit or small duplexes, fourplexes, and then others who have it's been a disaster. And just some of the keys that you all have found. If you all have a couple hundred units, you've probably done some things right.
Yeah, I would like to. I appreciate that. Yes, I would say we've learned some good things, and I think we could actually give a very interesting conversation about that. We have some very strong opinions on multifamily real estate, and we could really dig in hard on that. That would be fun.
Yeah, maybe we'll do it on the next call unless something crazy happens in the markets. But we've been able to double money in about 18 months on some of the stuff we've done. And let me reiterate that unlike house flipping where you have the, you buy the house, you flip it, you make it a little nicer. But if you go through a recession while you're doing it, then the comp sales can drop, and then you're not going to make as much money. In commercial real estate, you have what's called forced depreciation. So if you find an area like a multifamily building that the rents are relatively low, if you go in and you renovate it or do whatever you need and you push the rents up, then you force the appreciation because these commercial units are based on their income. And that's kind of how we do it. We know already what the value could look like based on how much we can raise the rent.
Yeah, and Itai, I think we should definitely dig in on that on the next call. We could really go very hard into multifam. We'll make that like an educational crash course. One of the questions that I'm getting from Faraz, who's got some background noise, said it would be great to talk about the cities we think would benefit from this work from home culture. People leaving SF and where they're going. So, this could be, I don't know if we have any hard data about it, but, would be cool to talk about a little bit.
Sure.
I mean, it seems like Austin is like the natural landing spot for a lot of people in Los Angeles. I definitely see that as like one of the outflowing places, especially there, San Francisco. You just get a bunch of people are making a bunch of money. They're selling a company. They have a liquidity event. They don't want to pay the taxes. They're tired of dealing with the politics out there, the prices, and they're coming out here. I feel like I'm hearing a similar story of people who want the outdoor world in Colorado, the tax benefits of being in the Nashvilles of the world.
Nevada is benefiting too.
Yeah, definitely. I feel like Arizona keeps popping up too. Florida, for sure. Florida, absolutely. Yeah. Any of these places where it's good weather, no taxes, and has like what would be that good quality of life to be outdoors.
But even places in Oklahoma are really booming, like Tulsa and Oklahoma City.
Yeah, absolutely. Larry said, I hear that from space you can see U-Haul trucks going from California, New York to Florida and Texas. I don't know if he was joking or not, but I'm sure there's a way to actually see that type of stuff.
I'm sure.
Usually you can, I think there's some site that will show you the rates, like the move from California, let's say to Austin, and then moving from Austin back to California and the difference in the rates, because they want to get those trucks back without having to pay for the transport. And it's a lot more expensive to move out, from, like into Austin than it is from Austin going back to California. And there's some place that like tracks that information. It can kind of show you where the flows are and what the prices are adjusting for like the U-Haul.
So Rob,
you can just go to uhaul.com and check it out.
Sorry, can you repeat that? Whoever was talking, I cut you off.
Oh, that was me. So you can just go to uhaul.com and price a trip, and it'll tell you.
Yeah, that's definitely interesting. I know we got Michael Flaxman who's on the line right now. Michael, you might have a way of pulling some of that data about what's happening on U-Haul's website to some of these places. That actually would be a fascinating thing to see if you get bored.
I just know at one time my brother lived in Scottsdale back when it was the big booming thing in 2005. And he was telling me the rate of taking a U-Haul into Scottsdale and how much more expensive it was than taking a U-Haul out of Scottsdale to anywhere. It was like a 3X or 4X price difference.
Wow.
I believe it entirely. That was very smart. I like it. Chris hated Scottsdale. Chris, why'd you hate Scottsdale so much?
Douchiest place on the planet.
So this will be the point real quick before you expunge into it. Everybody, we're just now going into the final 10, 15 minutes of where we all say whatever we want and have a good time. We just kind of hang out and have some fun. So we'll let Chris tell us more about that. Everybody else, you're free to go, have fun. But if you want to hear why Scottsdale is the douchiest place on earth, Chris is going to tell us.